Hey, everybody. Paul Rabelais here. I had a lot to share with you, so let me get myself situated and we will jump in. Great to have you here this evening. Another big topic, another timely topic, because it's kind of in the middle of tax season, so we're going to address some tax stuff. So I got a call last week from a CPA who I know, and I get this call, and I get on the phone with the CPA, and the CPA is like, "Well, Paul, and I got to ask you some questions. I have a client, we have a mutual client, and they told me that they created a trust with your firm last year. And so I don't know what's going on." The CPA says, "Do I have to file a trust return?" I know I think the CPA says the trust income tax rates are a lot higher. Did this person make a mistake setting up a trust, because there's just a lot more reporting requirements and more tax due? And I was almost like, you got to be kidding me. You're a CPA. You ought to know better. So we'll get into the gist of what happened and why it happened and what are all the rules. But I get that kind of thing several times a year, both from CPAs. I get it sometimes from people in the financial advisors, the wealth managers. They're like, "What do you mean you set up a trust for this client? Doesn't trust, I hear trust tax rates are high, and there's all kind of new filing requirements." And I'm like, just, okay, time out. Let me educate you here. So I'm going to educate you, the viewer here this evening, the same way I educate some of the CPA community, some of the accounting community, some of the wealth management community. So you'll be on top of it. So, all right. Ann, welcome. Brenda, welcome. And of course, Larry, welcome. And New York, we've got Western New York. Sheila, nice to have you. Don't recognize that name, but always good to see both the old names and the new names. So this topic is important. It's timely because, as I mentioned a moment ago, here we are late February. A lot of people are going to be doing their income tax returns in March in order to comply with the April 15th filing requirements. So this one's timely. Trust income tax rates versus individual income tax rates. And like I say every time, I'm going to present some information. Love to see some contribution in the chat, whether that's a comment, experience, a question. Of course, we keep it positive. Everybody does a phenomenal job with that. So look forward to sharing some of that chat activity once I finish some presentation material here. So I want to go over kind of why this is important. I want to go over, just tell you flat out what's the math, what's the rates. And then we'll talk about when trust tax rates apply to trusts and their income. And then we'll talk about trusts as beneficiaries of IRAs as it relates to trusts having to pay income tax. So a lot of good stuff here. A lot of stuff people don't really recognize, even people who are fairly sophisticated in the area of income tax and even trusts. So we're going to hopefully give you a little leg up so that when you're at your next cocktail party, they start talking about trusts and income and estate planning, you could say, well, wait a second here. I just watched a live stream with my friend Paul, and let me tell you what he said. And so anyway, if you're talking about taxes at cocktail parties, maybe not a real interesting cocktail party. All right, enough of that. All right, so this topic is important, frankly, because a lot of people make mistakes. A lot of people make false assumptions. I get the calls from the CPAs. I get the calls from the wealth managers. Sometimes in those initial conversations that I have with prospective clients, they start questioning, what's the deal with taxes? You're talking about setting up a trust. Aren't there greater taxes on trusts? So a lot of false assumptions. That's why, we want to set the record straight. Great that this video will, be on YouTube permanently. And throughout the live stream here, I'm going to be referring to an example. And I try to have a real simple example, maybe not real practical, but I want to keep it simple because I want you to understand concepts not within a real complex example. So let's say Grandpa, I'm going to call him Grandpa Senior. There's Senior, and then there's Grandpa's son, Junior, and then there's Junior's son, the third. So there's only three people involved in this example: Senior, Junior, and the third. Let's say senior is 75 years old and he has, $6 million. That's what's, add up his estate at $6 million. Now, for purposes of our discussion, it could be $600,000. It could be $20 million. I'm just going to use $6 million, even though that's more than most people have. But lots of people out there with $6 million estates, and it really, as I use that number, it starts to show how important getting this stuff right is. So this is not necessarily an estate tax conversation. The $6 million that grandpa has is under the $13.61 million estate tax exemption for people who die in 2024, but we realize the estate tax exemption is going to be cut in half unless Congress takes some action. Going to be cut in half on January 1, 2026, cut back to $7 or $7.5 million. But grandpa doesn't even have that. He has about $6 million. And so he's got a son and a grandson. And we'll say in our example, again, not real typical scenario, but possible. And it's a good example to show you what we'll be talking about. Grandpa says, I've got a couple of kids, but geez, he says, my kids, Junior and my daughter, they're better off than I am. They've done really, really well for themselves. They don't need an inheritance from me. So grandpa says, I have one grandchild. Junior has a child, the third. And so I think I'm going to leave my $6 million to Junior, but Junior's only 25. And grandpa says, boy, if I'd have gotten $6 million when I was 25 years old, I would have had a good time. I'd have traveled the world. I'd have wine, women, and song. And my life would not have probably worked out as well as my life has worked out because I started with nothing. So grandpa says, I do want to leave it for my grandson, but I want to leave it in a trust for Junior, or the third, actually. So that, he doesn't have an opportunity to just go blow it. He's got to, he's got to bootstrap his way up, but I will make his life easier. So we'll be talking about that example of how grandpa or senior has $6 million, and he's going to leave when he dies, leave that $6 million to a trust for his grandson, the third, and he's going to name grandpa's son, Junior, as the trustee of that trust. And I'll be referring to that arrangement where grandpa dies, leaves his estate to a trust for the grandson, but names son as the trustee. Okay. And let's say grandpa's 75, or rather senior is 75, junior's 50, the third is 25. All right. So I'll come back to that in a minute. Now I'm going to hit you with the rates. And most of you are somewhat familiar with our kind of graduated income tax rate structure. Some of you probably are aware that there are 7 different tax rates. Some income gets taxed at 10%, some income taxed at 12%, some at 22%, some at 24%, some at 32%, some at 35%, and 37%. So those are the tax rates, whether you're single or whether you're married or whether trust is being taxed on its income. And we know that the income thresholds for each tax bracket change each year, adjusted for inflation. Now let me show you the distinction between individual income tax rates and trust income tax rates. So for 2024, and nobody's doing this reporting because you don't do your 2024 reporting until due April of 2025. But for 2024, let's look at on the individual side. Let's look at a married couple filing jointly. I think that's probably the most popular kind of return that's filed. Married couple filing jointly, they'll pay federal income tax at the 24% rate on the income that married couple has that exceeds $201,050. So income up to $201,050 is going to be taxed at some of it at 10, some of it at 12%, some of it at 22%. And then that married couple filing jointly will pay income tax at the very highest level or highest rate of 37% on their income in 2024 that exceeds, big number, $731,200. All right, so now you have an idea of what the married couple filing jointly kind of tax rate is. I just picked a couple of the rates they pay tax on at 24% on income that exceeds $201,050. And it goes up to 32, 35, and then 37% on that married couple filing jointly paying income tax at 37% on income that exceeds $731,200. So that's the married couples filing jointly rate and threshold. Now let's look at the trust. And when I say trust, it's really trusts and estates. I won't talk too much about estates, but yes, when someone dies prior to the assets being distributed to the heirs, the estate is likely to have some income. So that estate income is going to be taxed at the same rate and same level that trust income is taxed when trust income is taxed. And we'll get to that. But trusts and estates have highly compressed tax brackets. You remember a moment ago when I said married couples filing jointly pay tax at 24% on their income that exceeds $201,050? Well, trusts and estates pay income tax on trust and estate income at 24% when that trust and estate income exceeds $3,100. Married couples filing jointly pay income tax at 24% when their income exceeds $201,050. Trusts and estates pay income tax at 24% when their income exceeds only $3,100. If you look at the 37% rate, married couples filing jointly pay income tax, federal income tax at 37% on their income that exceeds $731,200. Trusts and estates pay income tax at 37% on trust and estate income when that trust and estate income that is taxed exceeds $15,200. Huge difference. Okay, so with that being said, yeah, it's not really good when trusts have to pay income tax, because if the trust has income that exceeds $15,200, they're paying income tax at 37%. So you're probably starting to get an idea where the rates are the same, but these thresholds at which the rates come into the picture are vastly different for individuals than trusts. Okay, now here we go. When do the trust income tax rates apply to trust income? First, let's talk about when trust income tax rates don't apply to trust income. So trust income, rates don't apply to trust income when the trust is what's called a grantor trust. Our Internal Revenue Code has rules that says if a trust is set up by a grantor is a person who sets up a trust. That person is called either a grantor or a settlor or a trustor or a trust maker. Our Internal Revenue Code calls these the grantor trust rules. But if somebody sets up a trust and they retain certain control over that trust, even though it might be a revocable trust or it might be an irrevocable trust, if there are certain elements of control that the grantor retains in that trust, it will be a grantor trust. And grantor trusts don't pay tax at the trust level. All of the income that the grantor trust assets produce all gets taxed at the grantor's individual level. Okay, so the grantor trust rules are complicated. If the grantor possesses kind of sufficiently specifically enumerated rights over the trust, they'll be considered the owner of the trust. But there's one kind of grantor trust that we see far more than any other kind of grantor trust. It's the kind of typical that so many Americans are out there creating, the typical revocable living trust that's designed, that typically is designed to avoid probate at the death of the grantor. So go back to our example, senior or grandpa, $6 million. He says, I'm going to set up my revocable living trust because I don't want my son and my grandson to have to go through that difficult and expensive court and attorney involved process when I die. So Grandpa says I'm going to set up a revocable living trust, put my $6 million of assets in that revocable living trust. That way, when I die, yes, all those assets will be included in my estate when I die, and they'll get a step up in basis. But then they'll be able to be immediately transferred over into that trust for my grandson without court and lawyer involvement. So that revocable living trust is a grantor trust. So, and because it's a grantor trust, the trust doesn't, that trust while grandpa is alive, it doesn't file any kind of trust income tax return. The trust doesn't pay any taxes. All of the income that grandpa's revocable living trust produces while grandpa is alive, because it's a grantor trust, and a revocable living trust is by definition a grantor trust, then if that trust produces, because the trust has some rental property and the trust has some income producing stock, maybe grandpa has a few CDs earning 4 or 5% interest, but let's say that $6 million produces, I don't know, $200,000 of income in a year. While grandpa is alive, he sets up his revocable living trust. He transfers his assets to his revocable living trust. He and his financial advisor and his CPA and his lawyer all know that it's a grantor trust. And so that $200,000 of income that those trust assets produce gets reported on grandpa or senior's personal income tax return. Maybe if he's married to grandma, they'll be filing married filing jointly. But note, and even on, for example, if grandpa has brokerage accounts at, could be Fidelity, Schwab, E-Trade, Vanguard, even though some financial institutions kind of mistakenly say when grandpa brings his trust instrument in order to retitle his brokerage accounts into his trust during his lifetime to avoid probate when he dies, maybe that financial institution employee will say, well, grandpa, you want to transfer your assets to a trust. Your trust needs a tax ID number, and that's actually incorrect. So all the regulations are clear on all of grandpa's or senior's trust accounts. He can use his Social Security number as the tax identification number for the trust. So again, all that flows through to his personal return. So one of the key points here to remember is a revocable living trust, which may be, the kind of trust, even though there's hundreds of different kinds of trusts with thousands of different potential provisions, that revocable living trust that people transfer their assets to avoid probate. From an income tax filing perspective, it's a grantor trust, and the trust doesn't have any kind of reporting or tax paying requirement that income flows through. Now, there's a number of other provisions that could be in a trust that make it a grantor trust. All revocable living, people tend to categorize after watching videos and learning a little bit. People tend to maybe mistakenly categorize from a tax perspective all trusts as either revocable trusts or irrevocable trusts. And people mistakenly believe that if it's a revocable trust, it's a grantor, and if it's an irrevocable trust, then it's not a grantor trust. So all these trust tax rules are gonna come into effect. That's not necessarily true. All revocable living trusts are grantor trusts, and all revocable trusts are grantor trusts. But some irrevocable trusts can also be a grantor trust, which means the grantor, pays the income tax on all of the trust's income. The trust doesn't file a return and pay taxes. So, for example, if a grantor, a person who set up a trust, even if it's an irrevocable trust, has the power to direct that the trust income or principal go to themselves or their creditors, that's one of these many administrative functions that can make a trust a grantor trust. So there's a bunch of different kinds, but they're not used nearly as much as the revocable living trust. When it comes to tax time, it seems like there's lots of explanations being made all across the country. Hey, CPA, hey, financial advisor, hey, person who set up a trust, you have a revocable living trust. It's a grantor trust under the grantor trust rules. Trust doesn't have to file a return. Trust doesn't pay any taxes. If that trust account produces some income, report that income on your personal return. And so that's a scenario where the trust isn't paying tax at 24% on income that exceeds $3,100. The income is flowing through to the grantor, so those individual tax rates apply. Okay, so and in our example, we know that while Grandpa was alive and he set up his revocable living trust with $6 million of assets, we know that that's a grantor trust and all the income flows through to Grandpa's personal return. Now let's say Grandpa dies. Now all those assets are immediately, because when someone with a revocable living trust dies, their trust becomes irrevocable when they die. Nobody can change the terms of their trust after they die. So Grandpa dies, the trust becomes irrevocable. Now it's in a trust for the grandson, and son is the trustee. So senior Grandpa died, left in his revocable living trust. He said that when he dies, everything goes to a trust for the third grandson with junior son as trustee. Now we have a non-grantor trust there. And now we have to look specifically at what are some of the trust provisions, what happens with the trust income to determine whether an individual or whether the trust is going to report trust income after Grandpa dies. So the general rule is and let's say that trust says that after Grandpa dies, the assets go into a trust for grandson, and grandson is both the income and the principal beneficiary of that trust. Key being he's the income beneficiary. So grandson, as the years go by and that trust generates income, grandson or the beneficiary pays income tax on distributions of trust income that's earned during the tax year. So let's say Grandpa died in 2023. Now it's 2024. That trust has $200,000 of income. And let's say, and it doesn't always work out this way because it depends how the trust was written, but let's say if $100,000 of that income was distributed to grandson, grandson is going to pay income tax on that $100,000 that was distributed from the trust to grandson by son as the trustee. And then if $100,000 of that $200,000 of income was accumulated in the trust, then the trust will file a trust income tax return and have to pay income tax at those higher trust income tax rates on the income that was accumulated in the trust. Now, many trusts that are done like this, maybe Grandpa set up his revocable living trust to say that after he dies, the trust becomes irrevocable. Grandson is income and principal beneficiary. And maybe Grandpa provided in his trust that all income shall be distributed to the income beneficiary each year. So if there's that directive in the trust, then after Grandpa dies, the $6 million that's in trust for the grandson produces $200,000 of income. All of that gets distributed to grandson. Grandson pays, receives that $200,000 of income and pays income tax, reports that on his personal return. The trust pays no tax because it didn't accumulate any of the income. Now, some trusts will say, because the trust we just talked about said that the trustee was directed to distribute all trust income to the income beneficiary each year. And that ensures that the trust never accumulates income and pays income tax at much higher trust income tax rates. But sometimes Grandpa could have set up his trust to say that after Grandpa dies, the trustee shall have the discretion to either distribute trust income or accumulate trust income. So maybe when Grandpa set up his revocable living trust, he said to himself, well, let's see here. My grandson, I'm going to leave this $6 million for my grandson, but he's 25. I don't know if he's going to turn out okay. So I want to give my son, who will be the trustee of the trust for my grandson, the maximum discretion. I'm going to give my son the discretion to either distribute the trust income to grandson after I die, and that would be the way that would where there'd be the least amount of income tax, because then grandson would pay income tax at his individual income tax rate. And particularly if grandson is married, he can have up to $700,000 of income before he hits the 37% bracket. So maybe grandpa says, I'm going to give my son discretion to either distribute trust income after I die, or accumulate it. And that way, after grandpa dies, son can see how grandson is doing. If grandson is now 30 and he's got substance abuse problems, son, as the trustee, is probably going to say, I'm going to exercise my discretion as the trustee, and I'm going to accumulate this $200,000 of trust income that gets generated every year. Yes, son says, I realize the trust will have to file a return. The trust will have to pay income tax at 37% on all of the trust income that exceeds $15,200. However, that's the lesser of two evils. I'd rather, the son says, because my grandson, is on drugs, I'd rather the trust accumulate the income, even though the trust is going to pay income tax at 37%, rather than distribute the trust income to my son. Yes, maybe he's only in the 22% income tax bracket or 12% income tax bracket. Even though less tax will be paid if I distribute the trust income to my son, if my son gets all of that income after taxes, he's going to blow it and he's going to ruin his life even more. So you got to realize, when a lot of people say, they call me and say, Paul, I'm the trustee of a trust. What happens to the trust income? Always, the rule almost always is let's look and see what the trust instrument provides. All right. Now, as a side note, let's also say that grandpa, when he set up his $6 million revocable living trust, and he said, when I die, my trust becomes irrevocable, and it's going to go into a trust for my grandson, and my son is the income beneficiary. Maybe grandpa said, distribute all income each year, because grandpa hates the thought of having income accumulated in the trust and being taxed at 37%. Or maybe he said, I give my son the discretion to distribute or accumulate. And so let's say after grandpa dies, all of the trust income, $200,000, that's a lot of trust income, it does get distributed to son. And son does pay income tax on that $200,000. Maybe he'll pay tax at 20%. So he kind of nets $160,000 from that $200,000. Trust pays no tax. But let's say in addition to that $200,000 of income that gets distributed to the grandson after grandpa dies, because all of the income does get distributed, let's say grandson says, I'm also going to exercise my discretion, or my son, as the trustee, says, I'm also going to exercise my discretion as the trustee to distribute principal, not just the income. The trust generates $200,000 of income in a year. Son, who's the trustee, says, I'm going to make sure that gets distributed to my son, so he pays income tax at his lower individual rate. But son says, I'm also going to distribute another $150,000 of trust principal to my son, because son says I have the discretion as the trustee to distribute principal to my son for his health, education, maintenance, and support. And maybe the grandson wants to start a business and son thinks it's very valid for him to do that. Or there might be some other reason why it's in grandson's best interest for another $150,000 to be distributed of principal from the trust to that grandson. So my point here is, while son did pay income tax on the trust income that was distributed, that rental income, that those stock dividends, the interest perhaps on CDs or savings accounts that the trust held. On a distribution of principal, that is not subject to income tax to the son. It's kind of goes back to falling under the rule that in general, an inheritance is income tax free. So by distributing some of the trust principal to the beneficiary, that's not an income taxable event. It's just your grandson is receiving some of that inheritance in the form of the trust principal, no income tax due. So no income tax on distributions of principal. All right. So what you're probably starting to gather is because trusts only pay tax on income that the trust generates and the trust accumulates in the trust. When trust is accumulated, trust pays income tax, and that income gets added to the principal of the trust. So you're probably starting to get an idea of how it's rarely desirable to accumulate trust income in a trust unless there's a good reason for doing so. And a good reason might be that beneficiaries having substance abuse problems, or it's a special needs situation where a beneficiary could be penalized financially from receiving certain government benefits because they're entitled to trust income. Or if there's just a child with significant financial problems and you don't want to even dump the income into their lap, much less the principal. So there typically has to be some type of compelling reason to accumulate income in a trust if the trust allows for the accumulation of trust income. Okay, so last kind of big point that I want to make is, because this adds a layer of complexity. Let's say part of what Grandpa had, part of his $6 million, was a $2 million traditional IRA. And so, and he dies, and, he dies when Grandpa dies and he's, 80, and his grandson is 25. So now we get into some of the see-through trust rules. Is Grandpa going to leave it to a conduit trust versus an accumulation trust? So let's say right out of the box, Grandpa has a $2 million IRA. He has to name his beneficiaries. He thinks he wants that to go to his grandson. He could just name his grandson as his beneficiary of his IRA, and his grandson's 30 when Grandpa dies. Now, if he just names his grandson, perhaps you're familiar with the rules that say grandson has to take all of that money out of the inherited IRA by the 10th year after Grandpa dies and pay income tax on it. That's the latest that income tax has to be paid on it. But if he just names grandson as the beneficiary, almost the day after Grandpa dies, as soon as grandson gets his hands on a death certificate, grandson can go to the financial institution and say, look, I know I don't have to take the money out for 10 years, but I want the money now. I want to go buy a house, a truck, a boat, and go do whatever. So a lot of people get kind of stuck on this. Well, grandson's not going to get it for 10 years as he's the beneficiary. No, that's just the latest that he could decide to take it if he wanted to prolong it that long. But he could take it all right away. And Grandpa doesn't like the idea of that. So Grandpa has a decision to make. He says, I don't want my grandson getting his hands on $2 million in one lump sum right after I pass away. So Grandpa's got to decide either to leave it to a conduit trust or an accumulation trust. Now, so Grandpa's got to say, you know what? What's more, at least in my view, what's more important to Grandpa? Paying the least amount of income tax? And if what's most important to Grandpa is that the least amount of income tax be paid, then maybe Grandpa leaves that $2 million IRA to a trust, and maybe Grandpa customizes that trust so that, generally speaking, grandson would get equal payments over that 10-year period within which income taxes must be paid. So let's just do the math. Let's not factor in, appreciation and all of that. Grandpa dies with a $2 million IRA. He doesn't want to just name grandson as the beneficiary because he knows grandson will cash it in and go spend it all within the first 6 months. So if Grandpa's thinking is, I don't want the trust to pay tax at 37%. So grandpa says, let's create a trust. Let's provide for equal distributions from that inherited IRA over 10 years. And maybe grandson would get $200,000 a year over 10 years. And because that was what I'll call a conduit trust, the trust never pays taxes. Um, uh, all of those distributions are the income taxes paid on it by son, and the trust doesn't ever pay any tax at 37%. So grandpa says, because I don't want the trust to pay, because I don't want this income taxed at 37%, I'll allow my grandson to get it over 10 years. And I know that's a lot of money that he'll get each year for 10 years, but that way the lowest amount of income tax will be paid because it'll be paid at the individual rate. Now, maybe grandpa says something different. Maybe grandpa says, I have a $2 million IRA. My grandson's 25 or 30 or whatever he is years old. And my stomach turns, grandpa says, if I know that grandson will get his hands on this money all within 10 years after I pass away. So grandpa says, even though I realize the trust will have to pay income tax at trust income tax rates on these distributions, I want this $2 million IRA that I'm leaving for grandson. I really don't want my grandson to get his hands on this money until he's, say, 60. So what'll happen is grandpa will leave that IRA to what I'll call an accumulation trust. Distribution has to be done within 10 years after grandpa dies. So the distribution is made to the grandson's trust within 10 years after grandpa dies. And then that distribution is not paid out to the grandson. It is accumulated in the trust. So now the trust has to report that as income because the distribution, the required minimum distribution, is accumulated in the trust. And the trust has to report that income, and everything over $15,200 gets taxed at 37%. So virtually all of grandpa's IRA will be taxed at 37%. But grandpa says, that's okay because I don't want my grandson getting his hands on all of that money within 10 years after I die. The distribution is made within 10 years after grandpa dies, but it's accumulated on the trust. The trust pays tax at 37%. And then that trust stays in effect and continues to, the after-tax proceeds get invested, and grandson will get his, hands on that money when he's 60, if that's what grandpa provided. So there's, extra layers that we have to look at. And these 10-year distribution rules are relatively new, 3 or 4 years old. And so it used to be that grandpa could set it up so that grandson would get distributions over his life expectancy, and grandpa could have left his $2 million IRA to a trust for grandson, and grandson would have received, little distributions over his remaining lifetime. No more, because it's all got to come out in 10 years. Unless, of course, you have a beneficiary who's disabled or chronically ill or meets one of those definitions of an eligible designated beneficiary that very few grandchildren or children do. So okay. So that's the dilemma that people with large traditional IRAs have when they want to really prolong payments to those children or grandchildren. They've got to do we make it a conduit trust and pay the least amount of income tax because the income tax will be paid at individual rates? Or do we make it an accumulation trust, realize that the trust will pay income tax on those IRA distributions at higher trust income tax rates? But once they do that, then the assets can be held in trust for a long period of time that's much longer than the 10-year rule. Now, one last point on that is, if you do have a large traditional IRA, grandpa had a $2 million traditional IRA, and he's sitting there at 75 years old, and he wants to leave that IRA to his grandson, and he wants those payouts to grandson to last for many years, more than 10 years after grandpa dies. One thing grandpa probably should be considering right now is converting that traditional IRA to a Roth IRA And maybe grandpa, if he lives for several years, he could do it over several years' time. Now, if grandpa dies with a large Roth IRA, hey, no problem leaving that to an accumulation trust. 10 years after grandpa dies, there is a required distribution, but it's payable to the accumulation trust, but it's a Roth, and the money comes out of the Roth income tax free. So there is no 37% accumulation trust income tax when a Roth IRA owner is trying to prolong distributions after death for a period that exceeds the required minimum distribution period for beneficiaries. Boy, that was a mouthful, but man, if you're starting to grasp some of this stuff, you're going to be ahead of the game. Okay, so let me kind of sum it up here. 3 quick points, and maybe if you're just tuning in now, now's the best time to tune in. Individuals pay income tax. Married couples filing jointly pay income tax at 24% when their income exceeds $201,050. Married couples filing jointly pay income tax at 37% when their income for a year exceeds $731,200. Trusts pay income tax at the 24% rate when the trust and estate income is $3,100 or more. And trusts pay income tax at the 37% level when the trust income exceeds $15,200. But not all trusts pay income tax at the trust income tax levels. Grantor trusts don't pay income tax. The income flows through to the grantor, so the grantor pays it personally. The most popular type of grantor trust is the revocable living trust. Still treated as your assets. Trust doesn't pay any tax. Now, when someone who has a revocable living trust dies and their trust becomes irrevocable, it's now a non-grantor trust. And so you look at the trust document to see whether trust income gets distributed to beneficiaries or whether trust income gets accumulated. If trust income of a non-grantor trust gets distributed to the income beneficiary, then the income beneficiary pays income tax at their individual income tax rate. But if that trust income of a non-grantor trust accumulates, now the trust is filing a tax return and paying income tax at that 37% rate on all trust income that exceeds $15,200 during the calendar year. So it often behooves trusts to provide that the trust income gets distributed to the individuals rather than accumulates. Sometimes, though, there is a compelling need to accumulate the trust income when you have a beneficiary, substance abuse problems, can't handle money, and how large is the estate, how much is the income, all factors into how someone may want to set up a trust like this. There are some special rules when trusts are beneficiaries of IRAs. It is really tough to stomach prolonging distributions beyond the required minimum distribution period for beneficiaries, because if you accumulate those required minimum distributions in a trust is going to pay tax at 37%. But if a traditional IRA account owner during their lifetime converts that traditional IRA to a Roth IRA, now there's no problem making that naming an accumulation trust as a beneficiary, because the distribution to the accumulation trust is free of income tax because it came from a Roth. All right, so a lot there, good stuff there. Last 2 days we've been through a lot, and let me run over to the chat and see what we have there. Hey Larry, hey Brenda, hey Ann, hey Sheila, hey Zuli Bella. A lot of highs, so I love the highs, love the little emojis, and that one too. Ann does her taxes in March, like most of us do. Sheila, thank you for subscribing. Thank you for the greetings, Sheila. And we got people welcoming other people. Always like people welcoming people. That's a good thing. Great. Charlie, great timing, helping. I knew this was good timing. Good stuff there. Our life insurance proceeds that gets funneled to a special needs trust taxed. Okay, so that's kind of our first substantive question in the chat. And I'm not tax consolidation. I'm not sure what you're getting at, Zully, but Jessica. So I think what we're getting at here is, let's say dad dies, has $1 million life insurance policy, names perhaps his child's special needs trust as the beneficiary. And so, because he has a child with special needs, maybe that child is, getting some valuable government benefits. And if the money gets paid directly to the child, they could lose their government benefits. So the government says that dad can leave that life insurance to a special needs trust, which is designed to supplement what the government provides to that child. So there's some very rare exceptions, but generally speaking, the rule that life insurance is income tax free to beneficiaries applies here, whether that life insurance is payable to an individual or to a trust or to a special needs trust. So when dad dies, they get his death certificate. The trustee of the special needs trust applies for the benefits to the life insurance company. Life insurance company writes the check for $1 million to so-and-so as trustee of the so-and-so special needs trust. That is not an income taxable event. Now, as the years go by after that, if that $1 million gets invested and starts producing income, could be producing interest income, dividend income, maybe rental income if the trust has rental property, then yes, that income, it gets taxed. And if that income is distributed to the beneficiary, then the beneficiary pays tax. If that income gets accumulated in the trust, as is often the case with special needs trusts, then the trust will be subject to the trust income tax rules. If there's over $3,100 of accumulated trust income, 24%, over $15,200 of trust income, 37% on that income. So good question there. Yes. And you seem to be very popular today. Lots of people talking to you and you doing a little bit of chatting. Love to see it. Should everyone who loses a spouse have a step-up appraisal of their property, even if they have a trust? Perhaps. So it may depend on the value, but what we're getting at here is, let's say, Joanna asked the question. Let's say a husband dies, and we know by rule whether they have assets, whether her husband has assets in his name or whether it's in his revocable living trust. It's exactly the same rule. Assets that are in someone's estate when they die get a step up in basis. In fact, if you live in a community property state, when the first spouse dies, all of the community property, not just the deceased spouse's half, but the surviving spouse's half, also gets a step up in property. So nice advantage there. Now, should you get an appraisal of the property? Well, depends on what the property is. So obviously, if there's stock accounts, if there's money in the bank, assets that are easily valued, stock, that's easy to determine. But let's say, I think probably what you're implying, Joanna, is if there's real estate. So should they get an appraisal? It's not required that the surviving spouse get an appraisal to determine the basis, but it could be a problem when an asset is sold after the asset owner dies, and then that's when the capital gain gets reported. So let's say dad died, he had a piece of land, or he had a home, or he had a business, and they don't get it appraised, but the family just kind of says, we think it's worth $1 million. And then that asset gets sold, say 3 years later, for $2 million. Well, the family is going to file, the appropriate tax returns and is going to report $1 million of capital gain. They're going to say the basis in that asset is $1 million because that's what we determined it was worth when dad died. We sold it for $2 million, so there's $1 million of gain. So the problem could come in if the IRS questions thing and says, well, wait a second here. How do you know it was worth $1 million when dad died? Did you get it appraised? How was it valued? Now you're sitting there arguing with the IRS because maybe the IRS is saying it wasn't worth $1 million when dad died. It was only worth $400,000. And now you owe capital gains tax on $1.6 million not just the $1 million of capital gain that you reported. So it sure would be nice at that point if you could produce an appraisal that you did get when dad died that showed it was worth $1 million. That would probably quiet down the IRS a bit. So not required that you get an appraisal, but if it is an asset that is, boy, difficult to value, like a business, or maybe like some land that there aren't many comps, or maybe there's antiques or stuff that's really hard to value. If it's a home, then there's lots of comps where even later you can determine approximately what that home was worth. So the more difficult it is to value that property, the more likely it is the IRS may question the value. Probably the more advantageous it is to get an appraisal. Obviously, the higher the dollar values get, if you have an office building that's worth $8 million, then probably worth sticking an appraisal in the file. In fact, you'll have to get it, if there's an estate tax situation, you're going to have to get it appraised for estate tax reporting. But I think in your question, you're probably asking, what if there is not an appraisal required for estate tax purposes? So great question there, and a lot to my answer. Would you use a disclaimer trust over a portability election? So depends. Some people say, some married people's, estate planning documents may say I leave everything to my spouse. But if my spouse disclaims some of what they're entitled to, I want to leave it to perhaps what you call a disclaimer trust. And then after the married person dies, the surviving spouse can either say, I want it all. I want to own all of it, and I want to be able to control it. And I'm going to make a portability election so that I get to use my deceased spouse's unused estate tax exemption. Or a surviving spouse may say, I'm going to disclaim some, let it go on down to the disclaimer trust, as you mentioned. And my husband will use some of his estate tax exemption. He'll use those assets to shield those assets from estate tax, and he'll have less. He'll use some of his estate tax exemption, and maybe still the surviving spouse will file an estate tax return, make a portability election so that the unused portion of the husband's estate tax exemption gets tacked on to the wife's estate tax exemption. So kind of depends on the circumstances there. All right, Larry talking to Ann talking to everybody. That's awesome. Boy, 3 emojis. Ann, you're on fire with all your emoji work. I really like it. Larry's welcoming Sheila. Sheila's welcoming Larry. Thanking everybody. Love to see all the talk back and forth. Boy, I scrolled down too fast. I lost where I was. Missed the official Susan. So it'll be, the recording will be on YouTube. You're welcome. Thank you. Well, you're welcome, Aaron. You had the TY. So, is a trust safe from a future wife if things don't work out? A lot there. So I'll give you a couple of different examples, because if you were sitting right here in front of me, Bradley, I'd say, what do you mean by future wife when you say, is a trust safe from a future wife? I'm wondering. And so Bradley sounds like a man asking about safe from a future wife. But anyway, so some married people say, instead of leaving ownership of my estate to my spouse, where they could leave it to their next spouse, I'm going to leave my estate into a trust for my spouse because I want to provide for my spouse. And then they're going to define under what circumstances is that surviving spouse entitled to distributions from that trust. And that trust will provide that, I'm going to leave my estate in a trust for my spouse. I'm going to define under what circumstances my spouse can take distributions from that trust for my surviving spouse. But when my surviving spouse dies, the remaining trust assets must revert back to my beneficiaries, my children, my heirs. That does better protect things from your spouse's next spouse. And then also what you were wondering is a trust safe from a future wife? Let's say you're leaving things to a son. Perhaps if you leave things to a trust for your son, and then your son marries a future wife, and then your son divorces his future wife, by leaving things to a trust for your son, probably made it less likely that those assets, those inherited assets, would get mixed up with other assets your son may have with his future wife. So there's some divorce-proof protection there. Okay, so Aaron, so it seems like the best option is to max your Roth IRA as it passes on with less complications, but can that go into an accumulative with possible equal distributions if kids? Yeah, so yeah, so many more options open up if you have a Roth IRA from a long-term planning perspective on providing for your children and for your grandchildren and those future generations so that they get distributions for an extended period of time. So many more good options with a Roth IRA than with a traditional IRA because of this 10-year rule that says the income tax just has to be paid within 10 years after the traditional IRA owner dies. And that income tax is going to be paid either by an individual or it's going to be paid by a trust. And if it's paid by a trust, then big tax rates, big income tax rates apply, which wouldn't apply if you left a Roth IRA to your future generations. So again, a lot more flexibility with the Roth, and as I was looking at these rules, I was like, man, even in my own situation, I was like, boy, I got to get this stuff in a Roth. Not only so that it'll be income tax free to everybody, but if I do want to prolong distributions to children, I have 5 children that are grown, 3 are already corporate lawyers, and 2 are in law school, so things are looking good. But I may want to do some things for grandchildren in the future, so having Roths would really help that as well. All right, so great question there, Aaron. Can you leave as a charitable? Yeah, you certainly can leave a percentage as a charitable donation. I think. Are you asking if you can leave, since your last question was about IRA? Yeah, leave that. You can leave portions of an IRA or portions of your estate to a charity as a charitable bequest, if that's what you're getting at. Or you could leave a percentage of your IRA, a percentage of your estate. So of course you can. Yep. Soto, so can accumulate up to 50,000. It's not income tax free. So let's get that straight. Good question, Soto. Soto, let me go back here. The first $15,200 of income that's taxable to a trust is not tax free. It's just that because we have 7 tax brackets, 10, 12, 22, 24, 32, 35, and 37. It's just that trusts reach the top 37% bracket when they have more than $15,200 of income. But as I mentioned as an example, a trust pays income tax at the rate of 24% on income that exceeds $3,100. And then a little while later, they jump up into the 32%, then the 35%, then the 37% bracket for income over $15,200. So no, I'm clearly not saying that income up to $15,200 of trust income is free of income tax. All right. Good. I'm glad the Roth IRA, I really want to encourage the Roth IRA stuff, particularly, not only because it comes out income tax free, but it just gives you more estate planning options if those are appealable to you. All right. Good here. So how long after, Charlie, good question. How long after the surviving spouse dies does the trust start filing an estate tax return? So does the trust start? So a trust would file a trust tax return, and estate, when assets are in the estate perhaps will have a requirement to file an estate income tax return. And I think somebody, if you're aware out there, but I think the number is $600 if income of an estate or a trust exceeds $600, then that triggers the income tax filing requirement. All right, let's see. Okay, so in an AB trust, besides income from the bypass trust, are surviving spouse able to touch distributed B trust principal for living necessities, even when her own trust has enough funds? Depends on the way the trust was drafted. So some trusts say that when Jane and John, when John dies first, John's assets go into a trust for Jane. Jane's ability to receive distributions of principal Um, Maybe it says that the trustee can make distributions of trust principal to the surviving spouse only after they've consumed or after taking into consideration whether they've used their own trust assets or their own resources. So sometimes you see that. So it depends on what the trust instrument provides. All right, Jennifer, let's see here. Yeah, well, I'm still learning. I'm 30 something years into it, and we're still learning. What would happen in the trust when the trustee dies and no success? I imagine the assets are turned over to the beneficiary. So, very good question. Oh, Grandpa left his trust to a trust for grandson, named son as trustee. And let's say son up and dies. So now the trustee dies. Well, if the trust was written as it should have been written, either a backup trustee was named, or at least there was some mechanism for determining who could be appointed as the trustee in the event of a vacancy in the office of the trustee. So maybe it says, hey, if the trustee dies and there's no trustee, so and so might be beneficiary. Somebody can appoint a trustee, or maybe it says, I name son as trustee of this trust, and after I die, son can designate in writing who his successor trustee is. Maybe it does say if son dies, then the trust terminates and the assets are just distributed to the beneficiary. Grandpa might do that if he just doesn't have anybody else that he feels comfortable naming as a trustee. So again, another one of those things that you look at the trust instrument that says what happens if a trustee dies and there's a vacancy in the office of the trustee. And that's the kind of thing that needs to be addressed in the creation of the trust, so that you don't fall into a set of circumstances where you have to go through a court proceeding to have a new trustee appointed. Sometimes many trusts say in the event of a vacancy in the office of the trustee, a corporate trustee would be appointed and would take over as the trustee. All the large financial services firms, or most of the large financial services firms, have their own trust companies. All right, so could you explain the new story of the college for $1 billion tuition free for doctors if you're able? I can't explain it because I don't know about it. Okay, Burps attended BU around the time you did. Fantastic. Yeah. So I was there, let's see, fall of 90, spring of 91. The Red Sox won the division. I went to a bunch of games, good stuff. And I went to some games in the Garden with my man Larry Bird playing there. So, all right. Thanks, everybody. Great audience. We'll see you next time. Tough topic, but seems like you guys hung on and you guys are getting smarter and smarter by the day. We'll see y'all next time.